Okay, welcome back, everybody. Here we are, Quant Bros, episode 3, long overdue. Is it long overdue? It's been a while, but here we go. We're gonna go for it. We've got Ryan here, all spiffed up, and I'm in a hoodie, so we've switched roles a little bit, but that's okay. We're gonna go over a few topics today. We're gonna talk about the difference between S&P 500 and Dow. Both are run by S&P Global, which is interesting, but both have stark differences. We're going to talk about Reflexive Flywheel a little bit. We're going to talk about a couple different authors that have shaped our view on the financial markets and design and thinking through, what we know and why we know the things that we talk about. And the last piece is talk about Bitcoin leveraged ETFs versus MicroStrategy. And then maybe we'll get into MicroStrategy holdings relative to all of the other companies. I think we can hit on quite a few topics. So without further ado, I think we're going to jump right into it. I've got a little glass of whiskey here. I've got Lagavulin today. And I've got a cup of tea too, right? Because, got to balance things. So without further ado, I'm going to kick it over to Ryan. He's running control on this today. And he's going to be flying through the documents.
Yeah, so cheers to Roaring Kitty. Me and Jeff definitely took a lot of inspiration from his work, and he always started off with a beverage kind of in the same way that we do. So cheers to keep
cheers to Roaring Kitty. I'm a roaring lion, so I got some big shoes to fill.
But yeah, it's great to be back. We definitely have something of a quality versus quantity element to our work, and of course I had like my delays with travel and everything, but we're back. We're ready to get into it. Anything else that we got to open up with at the top? If not, I'll go ahead and start sharing.
No, I think that's it. I'm excited to just get back into things.
It's
been a busy couple of weeks, man. Holy moly.
Real quick, the reason for the suit, sometimes it's nice to connect with my inner Lex Friedman a little bit. And I also I heard a story a while back about a hedge fund manager who forced his people to come into office with a full suit on. And Josh Brown on CNBC actually asked him personally, it's like, why are you doing all that stuff now? Those times are kind of changing. And he said, there's nothing casual about managing other people's money. And that always stuck with me. And I feel like I'm managing like my family's future money. So every once in a while, it's fun to check in with the traditional way of doing things.
You gotta love a tie. Tie just looks good. Yeah.
Thank you. The black and white, very nice contrast. Can you see my screen? You ready to roll?
Yeah.
Okay, so one of the first things that we want to talk about today is really kind of unpack the differences between, a company getting into the Dow Jones and a company getting into the S&P 500. And the reason for this conversation and the reason for leading with this is because this has been a big topic for MicroStrategy, of course. It's one of the biggest catalysts on the reflexive flywheel, which is something that we're going to get to shortly. And I think there's a lot of different opinions or thoughts or just understandings about the criterias, the processes, and just the general operating procedure of both the Dow and the S&P 500. And the reason I wanted to pick these two indexes, or the S&P 500 picked itself, of course, but then the reason I wanted to pick the Dow as kind of the analog here is because I think many people are describing the Dow inclusion process while they're talking about the S&P 500. So with that, let's get into this Yahoo Finance article, properly titled "How a Stock Gets Added to the Dow Jones." So we'll come down here. It starts off with the anecdote about when Exxon, Raytheon, and Pfizer were booted out of the Dow in place of Salesforce, Amgen, and Honeywell. And the thing that sticks out in that stanza is that Salesforce, Amgen, and Honeywell, that's not really like a very descriptive bunch of companies representative of, the US corporate America presence. And I know a lot of the companies that are in the Dow now are those types of examples that you'd be thinking. But when we think about like Nvidia, not in the Dow, Google, not in the Dow, Amazon only just recently, the Dow recently announced that Amazon was going in, but we could of course think of three probably more deserving companies that deserve to go in there, both on fundamental business metrics and in just total job creation. I mean, Amazon has 1.5 million employees, including the factories, the corporate, everything. So that should have been like a very deserving thing, you would think. But the point here is that it's very subjective. It's just a couple like old school companies that have been around for a while. And then the article goes on to say that Walgreens kicked out GE.
Walgreens.
Again, yeah, me and Jeff talked about this on our prep call that we do before going live. And it's like Walgreens, right? I would say probably the airlines are the most uninvestable industry in investing because of the capex and the maintenance costs and everything else and the liability risk and all that stuff. But then if I had to think of like a second tier of like just awful businesses that I never invest in, it would be something like Walgreens because there's direct competition that already exists. CVS, Rite Aid, Walmart's, all of those types of stores. Plus the fiat decay element here is huge. Me and Jeff have talked about this with basically every other company. They have to pay for their real estate, they have to pay taxes on their assets, they have to service and maintain them, their maintenance costs, they have to pay for energy. So that's one
Yeah.
of the recurring themes that we're going to come back
Yeah,
to.
the Dow is interesting, right? It's just I haven't looked into it too much, but it is interesting that if you turn on any news channel, they're always talking about what's happening to the Dow, what's happening to the S&P 500, and those are the two kind of main indexes that are followed on news channels. It makes you wonder, why are they following those ones? You know, if
Probably because of the biggest. One of my little jokes with the index is the NASDAQ is for the son or daughter, the S&P is for mom and dad, and then the Dow is for grandma and grandpa.
grandpa, yeah, that's fair. That's fair.
And forgive me if I cough, I'm still feeling a little bit under the weather, just in case that comes up again, but it's kind of like the echelon there of growth and aggressiveness.
Yeah.
And again, so back to the Dow S&P, this is really like the key distinction here. And I love how this paragraph here starts off with, unlike the S&P 500, which has a long list of eligibility requirements, right? That speaks to the difference between S&P inclusion and Dow inclusion. S&P is so primarily, or perhaps entirely, criteria driven, where it's like a binary, you either check the box or you don't. And at the point in which you check all of the boxes, you have to, and we'll get to the calendar in a second, at that next opportunity for companies to be added to the S&P, March, June, and then December, I believe, off memory. Once you check all the boxes, you wait for one of those time windows to open up, and you basically entered in, and one of the companies on the bottom is removed out. Versus the Dow, which is a very bureaucratic committee type process with no rules whatsoever. It's all arbitrary. There's no timeline structure. There's nothing like that. I couldn't even really describe how the Dow committee does this because it's just so opaque. There's no way to see kind of like what actually drives these decisions. And then
And I
lastly,
think, to be clear on the S&P 500, I think there is I think the final component is a committee approval. However, it's got to hit all of these other eligibility requirements before it has this kind of final committee approval. But to your point, it's far more calculated, and it represents 500-ish companies, and it's a mathematical formula, and that's the beauty of it as well, is it captures profitable companies that are trending in the right direction. And that's why it's such a great and interesting index to participate in as a part of a portfolio, or insurance companies holding S&P 500 or pension funds, is that somebody's already doing the hard work of finding the best 500 companies that are profitable and trending in the right direction. And that is purposefully calculated because you take the guesswork out of it, right? Like you take this uncertainty component out of it, of like cognitive bias of not including somebody because you don't like them, right? And so that's yeah, it's interesting. I mean, index design is interesting, very interesting.
Right, and then just to build off that quickly, there is an appeal to these types of things, especially the NASDAQ 100, because it's more concentrated. But when we think about NASDAQ 100 and S&P 500, they actually do offer real momentum, right? Because it puts good companies into the index and removes the bad ones. It takes on winners and kicks out the losers. In addition to acquisitions as well, right? Like when Amazon acquired Whole Foods, Amazon was already in the S&P 500. Whole Foods was a private company. It now leapfrogged in there. So there's kind of like this leapfrogging acquisition effect, plus the momentum of winners in, losers out, you know?
Yeah.
And then just to wrap up this article, I think this highlighted blue section really hits the nail on the head. And for the folks who may just be listening, I will read off the key points here. But this is really just saying that the Dow is not governed by quantitative rules in the way that the S&P 500 is. And then last sentence right here, the methodology is far more vague. So we just wanted to kind of have that discussion, have that back and forth to really paint the difference there, right? Between our understanding of the S&P 500 as me and Jeff see it versus a lot of the commentary that we're seeing on Twitter about it being more of like a bureaucratic committee type process. And I think that definition just more clearly fits the Dow versus the S&P. And just to briefly look at the criteria here, you know, we've got universe has to be US companies, eligibility, market cap. And this is, I'm not going to run through all this stuff because we've been talking about this, and Taylor Kenneth has really been pounding the table and updating his thoughts on this kind of stuff. Perhaps the one area where things do get a little wonky, or let me first start by saying that the Jeff pointing out the summed together piece that's right here in parentheses in terms of you know, positive earnings, that was a big like change in my understanding. But that's an example of something that's perhaps a bit more clear cut and easy to interpret versus some sorry for the coughing, versus it's like my Jordan flu game, you know, coming back with that. Me and Jeff were talking before going live here, and we were really focused on, you know, this float adjusted market capitalization metric.
Well, I think before you get into that, I mean, there's a reason I post the daily update of what the market cap is at the end of the day, right? And why what the market cap is, and the fact that they've been or qualified for the market cap threshold for 32 days in a row, or, you know, whatever the number is. And the reason is market cap is the hardest one to qualify for. And if you can qualify for market cap, then the next hardest one is financial viability. And financial viability meaning having positive earnings over the last 4 quarters. And I think Q3 2023 was a negative earnings per share. However, if you look at the last trailing 12 months, MicroStrategy does have positive earnings. I think it's $20 earnings per share. And if thinking about the change in FASB rules coming up at the end of Q1, we could be looking at historical earnings per share figures that are beyond fathomable. So if you think about market cap being the hardest, financial viability and earnings per share being the second hardest, we're talking about hitting 2 of the hardest qualifications for entering this S&P 500. Yes, there are other components, and some of these other components are more vague and difficult to find information on. And Ryan, you're about to hit on it. And the one that I think is a bit challenging to get any historical information on is this adequate liquidity and reasonable price. within this methodology construction, the verbiage that they use is a bit interesting, where they say the ratio of annual dollar value traded defined as average closing price over the period multiplied by historical volume relative to the float adjusted market cap should be at least 0.75. I've Googled this phrase. I cannot find any information on this calculation or how to actually pull it together. So I've kind of back of the napkined it, and I think I can get something that makes sense. But who knows how the S&P 500? This is obviously a proprietary calculation that they've come up with, that they are using on every single equity company in the entire stock market to give some perspective on adequate liquidity and reasonable price. So I think that's the one in my mind that might be a little bit of a question mark. They have adequate liquidity. They've got adequate shares trading. Daily volume shares trading is totally adequate now, but that calculation prior to that, there's a little bit of a question mark there. And the last 2 points are sector representation. So they're representing a sector within the S&P Total Market Index, and then company type. They are an eligible company based on the company type as outlined within the methodology construction. Also pretty interesting that REITs are eligible for being included in the S&P 500, which is seems kind of weird. Around you referenced a REIT being almost like an ETF for real estate, where ETFs are not eligible for inclusion, but REITs are. But when you think about a REIT is kind of a real estate. It's a real estate investment trust, but really it's like a real estate development company, because they are buying and holding real estate assets, collecting rents, but they're also establishing management companies that are generating fees based off of the real estate that they hold, and these other components. So when you start to think about a REIT being eligible for inclusion, and thinking about a potential Bitcoin development company that may be taking on a similar type model, but with a more financial construction, it seems to me like it would be a no-brainer. But yeah, I mean, we'll see. I think the biggest takeaway from this whole thing, and everybody is asked, when S&P 500?
Right.
It doesn't matter. It doesn't matter at all. The fact that there's a probability greater than 0 that they do get added to the S&P 500 in the next 12 months or 36 months or 48 months, whatever it may be, makes me want to buy this stock and hold it forever. Right. Alternatively, they're also already included in market cap weighted indices. So the stock is going to have positive changes to their market cap, which is going to result in more additional dollar cash flows from the indices that they're already included in, like the Russell, the total stock market index, et cetera, et cetera. So this is just jet fuel, right? Like, it doesn't matter when it happens. The fact is, they could qualify at some point this year. They got 3 cracks at it in 2024. You've got June, September, and December, and then you've got 4 cracks at it in 2025. So I think that there is a probability that greater than 0 that they get added to the S&P 500 at some point this year. And that alone makes me want to front run the rest of humanity that's going to be buying it when they do get added.
Yeah, really nothing else needed from me on this slide. Just to put a bow on that, the 2 big takeaways that I've had from this conversation going back and forth is that it is more nuanced than perhaps I had initially thought, right? The S&P 500 inclusion, mainly because there's these metrics that Jeff discussed that I've just never heard of before. So perhaps I had to adjust my perspective on that. Like I said, that was just a me thing. And then the second big point there was in regards to the timing, right? A lot of people have been asking, like, when is this going to happen? And we can speculate and try and piece a few things together, but the more important thing is that we're starting to check all of the boxes, like Jeff said, with the most difficult one being the market cap size. we're we're really starting to check all these boxes, and everything's starting to come together at the right time to include post FASB fair value accounting, and the ensuing profitability that'll come from that. So
I think another interesting topic that's come up a lot is people have said Coinbase will beat MicroStrategy into the S&P 500. And if those people did an iota of research, they would find out that Coinbase does not have positive earnings over the last 12 quarters. Nor I don't even think they've had it over the most recent quarter. So they hit it on the market cap. I think their market cap is 46 billion or something like that. I mean, they've got a higher market cap than MicroStrategy at the moment. However, they don't have positive earnings. So
right.
will they get out of the S&P 500? I think absolutely. Absolutely, once they have positive earnings and these other metrics are hit from their proprietary models or whatever.
Before I start coming off on Coinbase, because it's not my favorite operating company or even an investable business, because I think it's so competitive amongst the exchanges, but we also don't have to think about things in terms of like a competition, like who's going to get in first, who has the bigger market cap, blah, blah, blah. All of those details to me are like a secondary versus like which one's the better business. Plus, I'd rather still be at the smaller market cap because then it allows more like upside price appreciation without having the Nvidia effect, right? Of already being $2.2 trillion in market cap. If it was to 10x from there, the market cap will be the size of the M2 money supply at 20 something trillion. So
Yeah.
it is also beneficial to start small, and we don't have to make everything a competition.
Right.
And then if you had something else, I'm happy to go back, but just to keep trucking here for time's sake, just to finish up the S&P 500 portion about the criteria driven aspect, the objectivity that it takes for like a company to be included into the S&P. There's a full on, calendar, schedule, regular timing for these types of things, the inclusion events. And if anyone has seen this before, I know Jeff has posted a lot. You look for these yellow squares right here at the bottom, and then you can see, we got one in March, there's one in June, and then there's one in December.
There's one in September too. Somebody else pointed that out to me, but
Oh wow.
yeah. So I think this is a worthy calendar to take a look at. I think this is actually a really cool calendar in my opinion, because it's outlining some of the big index ETF changes that happen over the course of a year. So it's got all of I guess the legend down at the bottom. So it talks about, what's happening with options, monthly options expirations, and then it's got all of these details on the index. So it talks about the Russell indices. So that's coming up on the horizon. I think rank day for the Russell index is April 30th. And so the Russell indices represent, that's you've got the Russell 3000, the Russell 2000, the Russell 1000. I think there's a handful of others, but those are the three big ones. The 3000 representing, every single company in the stock market pretty much. The 2000 being the 2000 smallest and the 1000 being the 1000 biggest. So it outlines, when that money is moving, and you can kind of see how that happens on the calendar here. Additionally, it outlines the S&P 500, 600, 400, etc., NASDAQ 100 additions and deletions. Note that only happens once in December, whereas the S&P is happening quarterly. So there's a lot of moving pieces here, right? Like, and this capital is big capital, and there's a reason that it's outlined to happen at certain points throughout the year. So the capital can move, right? It needs to have some sort of certainty in the way that it operates, because there is tons of money that follows what these indexes do. Indexes,
Yeah.
Indices.
It's like the having debate,
Yeah. That's fair.
But yeah, that makes a ton of sense now that you say that. I'm glad you clarified, because I just learned that in the moment that it's 4 times a year. It's in the third month of every quarter.
Quarterly, yeah.
Yeah, March, June, September, December. So that's good, because then it gives us another opportunity for a shot on goal. You know what I mean? In terms of like, if we don't make it the first month, there's one right behind. 4 is better than 3, that sort of thing.
Yeah, I think are we going to talk about S&P 500 anymore, or are we switching gears?
No,
Because I think
what do you got?
yeah, I think there's two more topics that I want to hit on. And it's another one that's come up a lot is people look back at Tesla and other companies when they were added to the S&P 500 and trying to see price action after they were added to the S&P 500.
I'll just put this up while you're
Oh,
going.
here you go. That's perfect. Good. That's fun. So I encourage anybody that's listening that's brought up this topic to go look at like some of the research and the news that happens surrounding inclusion. So, for example, Tesla was uh, they were rumored to be added to the S&P 500 sometime in like July after the Q2 earnings came out. They had their fourth quarter in a row of positive earnings. They were rumored to be added to the S&P 500, and the price continued to go up from there. Additionally, they were announced to be added to the S&P 500 in November of 2020. And within that article, you can go see it's S&P Global put out this article saying that Tesla would be added on December 20th, 2020. I think the article came out on November 21st, 2020. So the whole world had a month to front run all of the index ETFs. So what happened to the price? The price went up 150 billion in market cap in a month before before they were added to the index. And then they were added to the index. So if you go look at December 20th and what happened between like December 20th and the week where they were actually added to the index, the price didn't move at all.
Right.
And so people have commented like, Jeff, what are you talking about? The inclusion didn't move Tesla at all. And it's like, no, that capital is so big that it transacts in dark pools off of the market to not impact price. And the reason that the price didn't move is because the price actually hit equilibrium because the rest of the world front run appropriately to match the money that was going into buy Tesla stock. So there were appropriate sellers on the other side of that trade with the same scale to match the S&P 500 incoming flows. So when you think about money and how it moves, news matters, right? Like it's not the date on which it happens, because it's like, if you know this information, why wouldn't you act today as opposed to, it's a buy the rumor, sell the news kind of thing, right? It's like this is typical standard shit. And if you think about the scale of this capital, it's hard to move that much money. So they're going to do it over time, and they're going to do it on dark pools. And I wouldn't be surprised if there were other funds like, let's say, BlackRock, who was buying Tesla in an alternative fund
Right.
to sell to their index fund, recognizing that they were going to have to buy it at some point. So they're probably buying it early in another fund that wasn't the S&P 500 vehicle in order to match the buy sell volume in the dark pool when the inclusion happened. I know that's a complicated theory and a complicated concept, but basically the news is important. Like when it gets announced is the important part. And even knowing that it's going to get announced at some point in the future, like you have the opportunity to front run everybody.
Right.
So yeah, I think that's a big topic.
Yeah, we're not going to get into the Tesla chart now. I just put that up for a background image as Jeff was explaining his thing. Quick primer on that. On our next episode, we are going to get into that because someone had commented on one of Jeff's posts saying like, has there been a company like this big, this size and like with this much like retail like shareholder support and like a charismatic CEO? Or is this something more of like an unprecedented situation? So we're going to unpack the similarities and differences between Tesla and MicroStrategy on that trajectory. One important caveat on that is I'm never implying that like that's what MicroStrategy is going to look like, right? Like we've all
Yeah.
seen the charts on Twitter where someone will overlay Cisco in the dot-com bubble, like and the run up leading to it, and they'll overlay with that like Nvidia and be like, see, like that's what's like going to happen here. It's like that's a very simplified view of reality. There were many differences between those two, the two time periods, the two companies, where humanity was politically. There's a ton of differences. So I'm not implying that that's what's going to happen with MicroStrategy, but it's an interesting kind of analog to unpack in terms of it, MicroStrategy perhaps not being unprecedented. But we good to keep pushing?
Keep pushing along.
So here's where I'm going to start to unpack and add a little bit of nuance to the phrase that I've been throwing around of the reflexive flywheel, and I've got it trademarked up here. One of the key kind of schools of thought or kind of prequel type pieces of information that one has to have a solid understanding on, and we're not going to have enough time to unpack it here, so I'm just going to do kind of a quick high level, like here's one interesting insight from it, is George Soros and his book The Alchemy of Finance. We got that written down here. In this book, he really, mainly focuses on talking about reflexivity in the various markets, whether it be Forex, the bond market, commodities, the stock market, all of them. And the one very important insight that I want to focus on as we unpack this a little bit is that when you have multiple catalysts that are all kind of coming to fruition in a similar time period, like close next to each other, and when these catalysts have elements of them that can be self-reinforced because of elements of another catalyst, then these trends can really become self-reinforcing. And if we look at the Soros quote here on the bottom, reflexivity refers to the self-reinforcing effect of market sentiment, whereby rising prices attract buyers whose actions drive prices higher within the feedback loop.
Yeah.
And the reason that's important is going to be some of the examples that we're going to unpack. I'm going to pass it off to Jeff here in a few minutes to show that. Let's look at two of the catalysts, and let me just jump down here.
Well, I kind of want to stick on that reflexivity for a second, and
Sure.
I just a thought came to me on Apple, right? Like
Sure.
Apple being one of the best stocks in the market. They came out with the iPhone. And the iPhone was like a boom, wow moment. Everybody's like, holy cow, this is going to totally beat the BlackBerry. Everybody's going to have one of these in their pockets. This is the mobile wave. It's turning into a computer into your pocket. That is media and all of this other stuff. And so that initiated a huge wave of buyers of Apple stock, which again drove up the market cap, which increased Apple's financial strength to have the ability to finance additional growth and research and development. And then you come out with an iPad. It's like, oh my God, boom, there's another product. And all of a sudden, it's again, the sentiment is kind of compounding, and people are starting to think about Apple as their savings account. And because they know that this like loop is going to continue to happen, and this reflexivity continues to grow, which continues to drive prices higher and higher, knowing that they are financially strong, they hold a lot of cash, and they have a great product, and sentiment is high. And the sentiment is so high that Berkshire Hathaway owns a ton of Apple,
Right.
and that's incredibly hard to break. So yeah, I mean, it's everywhere. It's not just this stock; it's everywhere, and it generally follows sentiment. I think that's a great sentence, that bottom one there.
Yeah, and I think one of the things we're going to touch on is how the reflexive flywheel can kind of be thought of as like JV ball for systems engineering, in that when you have these catalysts that can all influence each other, and it creates this feedback loop where one catalyst, such as a potential S&P 500 inclusion, you combine that with something like the short interest or the huge retail shareholder support for Sailor, or the fact that the spot ETFs are not accessible in every country because of bureaucratic things and government regulations. And you start to piece all of these things together. And what that does is you can imagine a scenario in which the market cap goes higher, right? That's the bottom line. How
Yeah.
that impacts the first catalyst I said of the S&P 500 inclusion is that the higher the market cap at the time of S&P 500 inclusion, the more shares have to be purchased by the indexes, the ETFs, the retirement accounts that model the time target dated retirement funds in corporate that model S&P 500 exposure. That's the more shares that all of those entities have to buy. And these are all price insensitive buyers. These aren't traders. These are people buying essentially with other people's money. So that's just kind of like the initial like JV ball here of systems engineering. And then in this post below, and this was something I had shared to kind of give some of the text without having to spend too much time unpacking it. So I'm not going to insult anyone's intelligence here on the flywheel. And then let's just get into the big picture here. Okay, so like I said, this is the reflexive flywheel is my attempt at like expressing and communicating what I feel to be a very dynamic system, in that as any of these catalysts start to become intensified, or let's say big news comes out at MicroStrategy World, that can start to have like an effect where it kind of bounces off all of the catalysts and strengthens them as they go. And some of these can be in multiplicative ways, like the example that I just ran through about the bigger the market cap at the time of inclusion, the more shares have to be purchased. All while there's more than $5 billion worth of money, worth of dollars betting against MicroStrategy. So yeah, the Soros related reflexivity element here is how these catalysts can really feed on each other, create the feedback loop, and it becomes self-reinforcing over time.
Yeah, I think you nailed it.
Right on. Do we want to pass it here
Yeah,
for
let's check out the Excel sheet, and we'll go back to this. It's cleaned up a little bit from the Quant Bros episode 1, and we can focus on it a little bit more. Bingo. All right, here we go. Okay. All righty. So getting into reflexive flywheel a little bit, looking at S&P 500 market cap weighted indices. So this is fun. What I've done here is taken the top 3 S&P 500 index funds. These are the SPY, IVV, and VOO. Collectively, they make up about 1.35 trillion of assets under management. So these are 3 of the 5 largest index ETFs in the world. And they represent a lot of capital, right? Everybody holds these. Pension funds, insurance companies, banks, life insurance companies, you name it, somebody's got exposure to it. So thinking about a hypothetical allocation for MicroStrategy to the S&P 500, I've looked at a couple of examples here. So let's say they're trading at a $30 billion market cap, similar to what DuPont is trading at. That would result in a 0.07% weight in the S&P 500. So I've got that included here, 0.07 weight. At that weight, so this is low end trading, damn near where they are right now in terms of market cap. So that's not taking into consideration any potential Bitcoin bull run within the next quarter or 3 quarters, the rest of the year. And so this is probably on the lower end in my mind of where I think they would potentially be added at. So with that allocation of 0.07%, that would result in $950 million of buy-side volume from purely just from the S&P 500. So that $950 million of buy-side volume would need to be purchased at the spot market. And people, again, just as we were talking about previously, people are going to know this is happening. BlackRock is going to know it's happening. Vanguard is going to know what's happening, and they're going to have to be purchasing shares in order to sell themselves shares to their S&P 500 index fund. Or, other retail investors are going to be front running them getting included to the S&P 500. So there's a multiplicative effect, right? For every dollar that is purchased, there is a multiplicative effect of how much that influences market cap. So I've brought some multiples down here at the bottom. So I've got multiples ranging from 25 all the way up to 118 times, which is the Bank of America Bitcoin multiple. So just to give some perspective. So let's stay conservative just to keep people's heads in the right place. So if that $950 million trades at a 25 times multiple, that would be a $23 billion change in market cap. And that would increase MicroStrategy's price by $1,388. So that would bring, all else equal, if that were to happen today, that would bring MicroStrategy's price to $2,938. And the reason we bring this up, because over here in the top, we've outlined the short interest shares. There are about 3.4 million shares short. Today's share price is $15.50, and dollar short is about 5.2 billion. So if you think about the price going from 1550 to 2,900, you can see how that impacts. That all of a sudden makes the shares short, instead of being $5.x billion short, you're about $10 billion short. So that increases the pressure of any of these funds that are short on this trade to close their positions, because they're starting to lose their shirt on their short position. And that continues to compound, right? And as you can see here, with the share price of 2,900, that pushes MicroStrategy's market cap up to 51.4 billion, which, in looking at the scenario testing, if they were to hold that $51 billion market cap moving forward, that would result in an increased allocation within the S&P 500. So any future dollars would be increased incrementally toward MicroStrategy. So assuming, let's say, instead of a 7% or 0.07% weighting allocation, let's assume a 0.15% weighting allocation. And then the difference there is staggering, right? Instead of $950 million of buy-side volume, you're looking at $2 billion of buy-side volume on something where the shares traded at the margin is already incredibly thin. Right. And we could see that in the volatility of the stock price. But so looking at $2 billion of buy-side volume, that again, looking at a 25 times multiple, you're looking at an as if MicroStrategy price of something like $5,900, which is, again, a staggering figure, and continues to put more pressure on the hedge funds that are short here. So if you were to take this $5,900 price and plug that into the short interest shares, about 3.4 million shares times about $6,000, all of a sudden the hedge funds that are short here are $20 billion in the hole. Right. So it just continues to compound on itself. And thinking about the reflexivity component, the sentiment is still going to be strong because they hold Bitcoin, and there's going to be less incentive to sell your shares to this passive money that's coming in the door, because the long-term perspective of the company is far greater than the short term. So, and I think that's a really big differentiator probably between this company and some other companies that have been added to the S&P 500. I think just recently, like Super Microcomputer was added to the S&P 500. And, they were added. There was a big run up, definitely some front running of the indexes that were going on. And then they were included in the S&P 500 and the share price came down. And I think what was going on there is people were starting to wonder, what is the long-term perspective of this company when you've got stiff competition with NVIDIA and, those other like chip makers and stuff. So I think the situation's a little bit unique. Well, it's definitely unique, certainly unique. And when you think about the relativity of how much Bitcoin MicroStrategy holds, and you think about these ETF inclusion numbers, it seems like a no-brainer just to zoom out, man. Like if you start to get worried about the daily volatility, just zoom out. Like look at what the price was 4 or 5 months ago and look at where you're holding it now. And like if you think it's going down, it might go down from here. It might go down significantly. And that's okay because the long-term perspective and the sentiment of Bitcoin underneath this seems to me to be like a trade worth holding on to.
Yeah,
So yeah, go ahead.
and we're going to talk more about the volatility and the variance in next episode, because I, of course, completely agree with you. And I think what Jeff did here was really paint the picture well of the reflexive flywheel concept. And we wanted to incorporate an Excel visual for this to show like the dynamic nature of it. You increase one of these numbers, it increases the like if we increase the weighting in the S&P 500 and then more shares have to be bought and there's a multiplicative effect that drives the stock price higher. Now the total dollar amount that's betting against MicroStrategy also grows larger. And we've only talked about a couple of the catalysts on the reflexive flywheel list. We haven't even mentioned, you know, what the impact of post FASB fair value accounting could be. So you've got all these things that are all coming to fruition reasonably in the same time period. And each of them has an ability to intensify and accelerate the other catalyst as that catalyst itself is becoming intensified. That's the self-reinforcing loop. And that's, you know, really what we're pounding the table on so much. With
Yeah,
this
and that loop and that loop can really only get broken if sentiment breaks. And if Bitcoin is holding the sentiment of this trade, it's like I don't know anybody that's a Bitcoin, a true Bitcoin holder is I mean they've gone through it. If you've gone through a cycle or two of holding Bitcoin, your sentiment isn't breaking, right? Like that means you held it through the highs and through the lows and back up to the highs where we are today. Like you've already been through it. So breaking that sentiment, breaking the psychopath sentiment that can sit and withstand that kind of volatility with low time preference and have a really thorough understanding of what's happening with the federal government and the Federal Reserve and how monetary policy works. I mean, holy shit. It's like these are smart people that hold this. This isn't like you know, I'm not taking a microphone to the people down the street to see if they hold MicroStrategy. Nobody's going to even know what this is. Like the retail people that are holding this stock know what they have. And if you start to get worried, just know that you're way ahead of the curve. Like you're the 0.001. Like normal Joe Blows don't know about this stock at all.
Right.
At all.
Geez, the coughs are killing me. But yeah, a lot of good points there. The one thing I'll kind of close with for this slide is that there's also a real like reflexivity with Bitcoin itself when you look at its catalyst right now with the 8 to 10 months ish. Don't kill me on the numbers, but roughly 8 to 10 months after the halving tends to be the most intense. I gotta go this way. The most intense price appreciation period for Bitcoin in its cycles. Plus, you layer onto that like the ETFs are like putting in just a relentless bid on Bitcoin, the underlying. Plus, you factor in we've got this, you know, Mr. 100 character who the Twitter folks seem to think that that's a nation state, whether Abu Dhabi or something tied to the royal family in Saudi Arabia, because perhaps they want to shift away from oil. Or we could speculate on all these things for days, but there are real catalysts, even just with Bitcoin itself. And of course, that is a driving feature of MicroStrategy, you know?
Yeah.
Okay, and then to keep on pushing here, one of the things I want to start doing is incorporating some of the authors and people who have like influenced me to like think this certain way, both to like cite the authors, give credit to them, but also really to provide like more content for folks who are interested in this stuff. Artemis Capital Management, it's not currently operational anymore, but it was founded by kind of the king of volatility type, a real thought leader, pioneer in the space of volatility. He made his life's fortune during the 2008 crash, when everyone else was losing their fortunes, so to speak. Something to the tune of turning, $100,000-$200,000 into $20 million through the crash by buying VIX futures. So he's really locked in on this stuff, really understands volatility from a first principles perspective. So we got the website up here, and we're going to put all this in the comments or the show notes on YouTube, but just so people can see, which page it is. Because when you start unpacking some of this stuff, I mean, shadow short convexity and the prisoner's dilemma. And then he unpacks like the machine learning, volatility targeting, risk parity, liquidity constraints. And then you start talking about the black swans in the prisoner's dilemma. And he's just put on such a great thought leadership exercise for things like, 1987 Black Monday, which he's referencing here, where, not that the VIX existed back then, but if it did, the VIX started 3 years after the 1987 event. But if it did, the VIX would have hit 150 on Black Monday. And he goes to great lengths to explain kind of what he believes caused that, and he just really does a great job of unpacking many things. The artwork is remarkable. And now there's one quick topic, another one of his works of research that he's shared that I've just learned a ton from. And we're not going to unpack this fully. We could do multiple hours just on the buyback conversation, because to me, corporate buybacks is the most nuanced and complicated topic in all of finance, right? There's many people who are staunchly against it, many people who are staunchly for it. And there's also a big quality issue with buybacks. For example, IBM typically does all of its buybacks with debt while holding very little cash reserves. You compare that to something like Apple or Google, who has a ton of cash already. They can either just buy shares with their own cash or take on debt as well. But their debt is kind of backed like 1-to-1 with actual dollars. So they're not increasing like business risk by taking on like the reckless component of leverage, because they have the cash, but they can borrow cheaply. So not to fully unravel that, but there is a quality dynamic between like what the low growth companies are doing and how they're doing buybacks versus how the more successful companies are doing it.
I absolutely love this way of thinking, right? This is getting into how it's the design of the financial world, and thinking about trading equities based on the design of the financial world, not necessarily, taking the casino approach, thinking like something's going to go up and something's going to go down. Like this is having a thorough understanding of the way that money moves and the incentives sitting behind the decisions that are made at the corporate level, and why buybacks happen, thinking about the incentives associated with that. And I mean, to me, that's the only way I will trade ever in the future, is having an understanding of like how the market moves and the design of the financial market, and understanding like the incentives associated with them. Because to me, that gives you a better long-term direction than anything else.
Right on, all the above. Like I said, we're going to talk more about
we could talk for hours about that. Like this could be,
right.
I'm excited to bring Adrian on. We're going to bring Adrian on and we're going to talk about this. I think that'll be a ton of fun.
Sure, yeah. And then just the one kind of to put a bow on this, the reason a company would want to do buybacks, and I bring myself into this conversation because, like, if you look at the reflexive flywheel stuff, or if you've just been up to date with my posts, I speak favorably about buybacks in 2030. Um, and that's complicated in and of itself. I think we should not be doing it until Bitcoin is either gone from the exchanges or completely, like, very much more illiquid on exchanges compared to where it is now. We're going to talk about all that stuff, but the reason that companies would do buybacks is because it's the most tax efficient way to return capital to shareholders. Meaning there's only about, and I'm not an expert on this, but we'll get caught up when we bring Adrian on. I believe it's only a 1% buyback tax, and that's it, versus the dividend tax where the company gets taxed and then the individual investor gets taxed to the tune of 20%. But like I said, this is a very, very nuanced topic. There's thought leaders who are very much against it, like Steve Jobs. Christopher Cole obviously speaks negatively of it at times. And the reason Adrian comes into this conversation is because his first long form article that he shared the other day, he was also speaking like negatively about buybacks. And like I said, I understand all those points of view because this is so nuanced. The Tesla folks were in a pretty big debate about 6 or 7 months ago about if Tesla should do buybacks. And I said no to Tesla doing buybacks. But I'm now saying that, like, in the future, I think MSTR should do buybacks given the Bitcoin stuff that I was just talking about. So like I said, that example right there in and of itself shows just how nuanced this stuff is. And we're going to really unpack that stuff, hopefully with Adrian.
Yeah, it all comes down to incentives too. I'm just like, wait, what makes the most sense financially? Do I invest in research and development or do I buy shares back? What is better for my shareholders? Because I mean, as you mentioned, it also improves the earning per share metrics with it. So you can have flat revenue, flat earnings, and buy shares back and artificially increase your earnings per share, which continues to improve sentiment, which continues to strengthen reflexivity over time. So if you have a savvy CFO, they know this stuff exists and they are thinking through the pros and cons of each one of these and how it works. I would say not every CFO probably gets it though.
Yeah, the financial engineering is of course big, you know what I mean? Earnings per share, it's earnings divided by share. When a company does, share buybacks, they're removing shares out of the float for the purpose of the EPS calculation. So when you're reducing the denominator, like what Jeff was saying, even in a situation where you have flat or slightly negative earnings, if you reduce the denominator enough, earnings per share goes up. Not really legitimately, more of like in an artificial sense. But yeah, this is going to be a fun conversation. I know we're both
For
looking
sure.
forward to
For
it.
sure. Yeah. Cool.
Okay. Moving right along. So this is the Christopher Cole gentleman who did all this research that we talked about. Like I said, I'm going to share this link in the show notes. This is one of the most like profound conversations I've ever heard on any topic, and ditto for the some of the text and research that we were talking about. I mean, this was like life-changing things for me to like think deeply on, especially with asymmetrical outcomes and just all these things. It's a very, very insightful learning experience. And with that, are we ready for the next topic?
Yeah. Yeah. Let it rip.
So yeah, what I wanted to talk about here was MSTR versus the leveraged ETFs, but also kind of MSTR versus the entire ETF umbrella, and really highlight the differences, because I think there's still been a ton of misunderstanding on like the value opportunity of an operating company versus an ETF, right? Like whether it was my debate with Doc Kruger a couple months ago, which already feels like ancient history. That's how much stuff has happened in between. or everyone talking about like, oh, well, there's like a leveraged ETF. So now that's like just automatically like better than MSTR. And this is something that I've been thinking deeply about. So it just made sense to get a post going. And at the top, I referenced the graphic that I've been sharing a lot. So let's hop into that. So I'm gonna go down the pillars here, starting with ease of access. So this is probably the only adjustment that needs to be made on the chart. This graphic came from, multiple earnings calls ago, so hence why that's not updated yet. This would be a green check here for spot ETF, but in terms of investor accessibility, there is something to be said about corporations or nation states or universities, right? Or maybe even like churches who are not going to hold Bitcoin the underlying. And this is like the Doc Kruger school of thought, where like not everyone's going to be nearly as motivated or incentivized to do that and watch BTC sessions for 4 hours and learn how to like properly set up a cold card MK4. Quick disclaimer, I do that. You know what I mean? Many of the people on Bitcoin Twitter do that, but of course they do because they're on Bitcoin Twitter and they're like interested in this stuff. Most people are not on Bitcoin Twitter. You know what I mean? They're actually working, they're with their families, they're doing stuff like that. We just happen to be like the fans of this kind of stuff, hence why we want more people to talk about it with, and we're on Bitcoin Twitter. So the investor accessibility of Bitcoin, the underlying on cold storage, simply doesn't work for everyone. And then going on to number two here, this is where the operating company stuff starts to come in. And it's really these next couple points that are all like a derivative idea based off of the operating company model. And the first point with that is that there's no fee to hold MicroStrategy, whereas there is a 20, 30, 40 basis point fee to hold some of the ETFs. And that might not seem like a lot at first, but that has a real like decay effect to it. You know what I mean? Almost like the opposite of like compound interest. Because if you're taking 25 basis points off the top of the whole thing, you're shrinking the fund in the way that like a hedge fund would charge fees. You know what I mean?
Yeah, and the other thing I would say is that they've got a 25 or 30 point basis fee now today. That might that might
Right,
go up. Like it could
right.
change. I think that's the other interesting component.
It could change, and what we know or what we feel extremely confident that's not going to change is there's going to be no fee to hold MicroStrategy, and that's kind of one of those distinction points.
Yep.
And then number three here, like I said, derivative of the operating company idea, MSTR can buy Bitcoin with cash flows or leverage cash flows either through the debt leverage option or by going through the convertible bond market. And that's really number four that I just started talking about with the borrow competitively. And also, what I would add to that is borrow opportunistically, right? The debt leverage option was the first option that was used by MSTR because interest rates were at zero, right? So there was no, future dilution event, and dilution's a whole nother topic that we could again spend an hour on in terms of fiat dilution versus this type of dilution where sats per share is still going up. Anyway, borrowing competitively and borrowing opportunistically. So when rates were at zero, they were taking on debt slash leverage. When rates are high, they're hitting the convertible bond market. Why that means something to me is that like we have both sides of the tail covered, like the interest rate like bell curve, meaning like whatever happens, either low rates or high rates, there's like an option in place that fits that environment to exploit that environment to keep increasing sats per share during what would be thought of as the loosening phase, especially from traditional investors.
And as the underlying Bitcoin grows, their asset capital that they could use as collateral also grows.
Right.
So like
Right.
the amount of capital that they can raise can also increase drastically as well. as a function of the underlying assets, right? I mean, what they've got $3 billion of debt right now, and their Bitcoin is worth 14 billion, something like that. So fast forward, let's say the price of Bitcoin goes to 100,000, then the amount of asset collateral that they have is 22 billion, and their debt is still 3 billion. So they're under leveraged at that point, and they can raise significantly more capital, probably for equivalent interest rates, which allows them to buy more Bitcoin in perpetuity. It's crazy. I mean, it's financial strength where they're taking advantage of the traditional financial market. Yeah, that's crazy.
Yeah, it's really interesting because the way you described it right there, it shows there's like a reflexivity feature in that idea in and of itself. Like
Yeah,
the stronger their capital balance sheet positioning gets, the more access they have to do these things to strategically acquire more Bitcoin.
yeah,
Um, and then
absolutely.
next point ties directly into that.
I want to go back one actually, and you kind of glossed over it. Bitcoin purchases with cash flows.
Oh, sure, sure.
Right, like right now they've got revenue from their software company, but if you think 5 years down the road, as a Bitcoin development company, they're going to be able to hire the best talent and build out the best teams in the globe when the price of Bitcoin rises, because the incentives of working at MicroStrategy is you're going to get paid in probably equity and maybe Bitcoin related. Or if it's equity, it's Bitcoin related. You're going to get paid. You're going to have some sort of like equity component to your compensation. So the upside of going to work for this company is going to be undeniable, which allow them to hire the best talent in the globe to generate future cash flows based off of whatever they do, whether it's like lightning or lending or whatever it may be. So when you think about cash flows, yeah, they have cash flows today, but they're also going to have cash flows in the future, and those cash flows in the future are likely going to be larger than they are today, and that like ETFs don't have cash flows. Their cash flows are from investors, and the ETFs are holding that cash on behalf of those investors.
Right.
Whereas this is like they're acquiring cash from the rest of the world via operations.
Yeah, I think that's a great point, and I love how like more of the catalysts like start to just seep into our organic conversation. But yeah, stock performance increases talent acquisition's ability to incentivize the best of the best, especially for the folks who want more Bitcoin exposure, you know?
Yeah, absolutely.
And then the mega example of that would be someone like Adam Back, like wanting more Bitcoin exposure and also being, wanting to kind of oversee technical proof of work type stuff at MSTR. Perhaps he would take a board seat, but that's a little bit of speculation for now.
Yeah. Cool. Keep cooking. Your shift. Yeah, I think you're on downside protection.
Sure, yeah. So downside protection. This is really the last main derivative that I would say to the operating company structure, which I see as a feature in comparison to the ETFs, which are not operating companies. You know what I mean? They're not driving revenues. They're not going to benefit from the post FASB fair value accounting change in the way that an operating company will, who has to, show its balance sheet and report all these different metrics like earnings per share and net income. But the real thing with downside protection is during the inevitable sell-offs, right? Whether it's a sell-off in a bull market or the seasonal slash cyclical bear markets, right? Think 2022 with the bear market ending at the time of the FTX collapse. But that was kind of the if you put any value into the Bitcoin cycle theory as it pertains to the halvings, that was right in line when like the time of the bear market would have came. And downside protection adds value there because the price, like the realized volatility that investors are going to have to experience with either a leveraged ETF or MicroStrategy is not solely dependent on the price of Bitcoin. That's like the key sentence. Whereas the leveraged
Yeah.
ETFs is very much only dependent on the price of Bitcoin, whereas MicroStrategy has other ways of adding value and keeping a bid on the share price.
I think the other thing to point out there is this is where index ETF inclusion really has a huge benefit, because if you've got a leveraged ETF, it's going to be super volatile. It's going to be like rocket up and down. As much as it goes up, it's going to go down equally, in the same leverage fashion. Whereas in this circumstance, I mean, in the short term, right, like, there's been a ton of shit going on in the short term. But if you look long term, and how I imagine this happening is that they're going to get included in S&P 500 index. And as the price goes up, their market cap's going to go up, and they're going to get higher cash flows from the S&P 500. And if there is a bear market, the S&P 500 is going to hold them up.
Right.
Because you have these continuous cash flows from people that are investing in the S&P 500. And so, like, if there's a natural sell-off in a bear market in Bitcoin, I could see, depending on how much capital is flown in from the S&P 500 and these index ETFs, I could see MicroStrategy being held up by the index inclusion, and that's something, again, the ETFs don't have, that kind of downside component. And the reason they have that index protection is because they are an operating company, not an ETF. So, like, if you're now in the future, like, if you're looking at a whole Bitcoin portfolio and you've got MicroStrategy and miners and all these other companies, at a point in time, might there be a better time to invest in a leveraged Bitcoin ETF compared to MicroStrategy? Sure. But that time I don't think is right now.
Wow, that's interesting. And without derailing the conversation, this might be one of those rare things we would end up disagreeing on. But I think there's a pro and con. There's a pro and con element to the concept of the price of the leveraged ETF being based solely the price of the leveraged ETF being based solely on the price of Bitcoin. That could either work out or it could also be a pain point, right?
True.
It's kind of nice because it's only one thing to worry about. It's only one thing to have to be thinking about and focused on. And if the price of Bitcoin goes up, there's no reason as to why, like, the leveraged ETF would not also go up. But that nothing goes up in a straight line. Nothing only goes up and doesn't have down days. So for me, in being a student of, like, the correlation theory of diversification, meaning you have to hold assets that, like, have a negative correlation to each other in order to actually, like, be diversified. Some days some things go up, the other days, like, the other things go up, and vice versa.
Yeah.
And
I'm more or less thinking of, like, oh, sorry to interrupt. Go ahead.
No, you're fine. And I think you actually do kind of achieve that a la downside protection by having multiple uncorrelated ways of adding value to the share price, whether it be
True.
Bitcoin going up because of the halving, because of the short interest, because of S&P 500 collusion, but also because of Bitcoin, versus the leveraged ETF just only being a proxy of the price of Bitcoin.
Yeah, I think I want to be really clear here. In my comment is not necessarily selling these assets that I already have to buy the leveraged asset or anything at any point in the future. If I have this portfolio of MicroStrategy shares and all of these other, Bitcoin correlated things, and at a point in the future, if I got a paycheck and I had $1,000 and I had to figure out what to do with it, and I may look at where Bitcoin is in the cycle of history and, maybe allocate my dollars appropriately based on that. So, like, it I mean, MicroStrategy still definitely has the advantage here, but um, you know, it's interesting thinking about non-correlated assets. I mean, ultimately, Bitcoin correlated assets to me at the moment have a better risk return trade-off than anything else in the entire market. Anything. So like there's no sense in my mind the diversifying away from that is right, selling the winners to buy the losers kind of thing.
Right. And this comes back to, I'm a monopoly guy. I love studying monopolies. I love studying Peter Thiel. So this is where we could even, not today, but a future episode, pivot towards like stressing the monopoly aspect, and kind of it's all of these variables in one, a la the reflexive flywheel, versus something like the ETF, which is just going to, where did my mouse go? Oh no, which versus something like the ETF, which is just going to give you price exposure.
Right.
And then to wrap this slide up, and hopefully I can find my mouse here. There we go. There we go. Okay, so to wrap this slide up, and thank you everyone for bearing with me through the coughs, but we're fighting through this kind of stuff like the Jordan flu game. Number 6 here, healthy derivatives. This is something that's still mildly unclear to me because I don't think we've put this into practice yet, whether it be like some type of like hedging instrument just to kind of, hedge our bets in the literal sense at the point in which that like Bitcoin cycle theory would come into play for the downside, right? Like if these price targets that people are putting out there of like 500,000 get hit right around that Thanksgiving 2025 timeframe, or even slightly before that, do we hedge? I don't think we're ever going to take anything off the table, but would we hedge with like some form of like a put instrument? That's what I think when I see healthy derivatives. But again, I'm I'm definitely no expert here on number 6, and I don't think this is something that we've actually put into practice yet. What about you, Jeff?
Yeah, I mean, I think this is primarily referring to the options market, call and put options. Like when this came out, I think this was Q3 23.
Correct.
Right, you could buy options on MicroStrategies. You couldn't buy options on Bitcoin, or the ETFs didn't exist. Right, like that's why it's a blanked out check mark, because eventually it will exist. In fact,
All
I think the options market for the Bitcoin ETFs is in the works. Actually, I saw something on this week. I think they're like, it's back to the drawing board or something. Like some people don't want to approve it or something, but I think it's referring to primarily just like CBOE offering long-term dated call options and multiple dated call options to manage your risk downside and upside.
Yeah, I think what I misspoke on there was I was looking at it from the company perspective, but I think you're right on this. What it's saying is from like the investor perspective, they have access to the derivative market for calls, puts. You can hedge in any number of complicated ways that way.
Right.
So yeah, to bring this discussion to a close in the same way that we weren't going to read through all the flywheel and all of these other text-based things because we already have them out there. Um, Let me just kind of set the stage for this. I went through and I looked at all the things that ETFs cannot do from just like the broad umbrella perspective of like how an ETF is functionally different or fundamentally different than an operating company. We looked at the leverage specific reasons or the differences between like BITU and MSTR. And then there's also something to be said about the optionality of becoming a Bitcoin development company. And I will say the jury is still out on this in terms of like how successful it'll be. And I think that's like a fair interpretation of it. But the broader point is here that like an ETF could never become a Bitcoin development company because it's not an operating company. It's just price exposure to the underlying asset. And then we've got the sailor premium here. I mean, this guy obviously does have a ton of very unique characteristics about him, and I'm not going to run through all of it here, but when you really start to list all these things or think about all of them pretty deeply, it is a very like compelling piece to the story that like the face of the organization is someone that has like Elon Musk level support, and like he's very well known and he's very well read and well spoken and all of these things here. And one of the things that I think does kind of get left out, because a lot of the fanboys, myself included, of Sailor, we do tend to over focus on him. But I think the company is full with A-plus players, from the executives and the engineers and everyone in between. I've looked at a I've looked at a lot of MicroStrategy like presentation videos or like fireside chats, and like this is like public stuff. People can register for it themselves too. Plus, I'm gonna look to share some of these videos. I'm really impressed with like the domain expertise and like the understanding of BI, AI, the understanding of like the engineering task and like building functional like software for clients, plus the consulting aspect. Like, I think there's a ton of like really high powered people here, which strengthens the idea of like the operating company versus the ETF, which is just price exposure. You want it, you want the organization to be filled with winners. And
It's only going to get better too.
right, yeah,
Right, it's like they're already filled with winners, but like they can make strategic hires to cultivate the best of the best in perpetuity. I mean,
right.
the incentives of working there are, if there's any equity program, it's like that in my mind beats any other equity program in the entire market.
Yeah. Yeah, and there's a ton of reasons for that, you know what I mean? And the one that I don't want to be swept under the rug is like the market cap where it is now. That base effect math concept of like the post I did the other day of like the personnel efficiency table, where I looked at like, you know, 40 or 35 like well-known companies and like MSTR's business competitors. Like it has the smallest market cap of every company on that list, thus providing like a conceivable upside versus that Nvidia effect that we keep coming back to. So between the base effect math concept, the monopoly concept, the fact that this equity would be such a strongly linked Bitcoin related exposure, that you could see a lot of like high powered employees wanting to flock towards MSTR just to have that be part of their compensation plan. Again, this is the reflexive flywheel idea here, where all of these things start to have like an accelerating effect on the other catalysts, you know?
Well, let's think about it here, right? So if you wanted to join the company and you got an equity plan, and at some point in the future, let's just say like your equity plan is you got 100 shares over the next 4 years, just 100 shares in total, like very small number compared to what you could buy today. You got 100 shares and you truly think you can help the company become the number one, develop their company to become the number one publicly traded company in the world. That's a $3 trillion market cap, and that's a share price of $175,000. So if you got 100 shares at $175,000, you just made $17.5 million, which is life-changing to most of the people on the planet. And so, like, yeah, I'm sure the equity plans are probably more compelling than 100 shares. And they're going to be able to get the best of the best talent in short order, I would assume.
Right. And I could see all of this like massively benefiting. Like perhaps that's the vehicle, or that's the method in which the Bitcoin development company comes to fruition, by more and more and more Bitcoiners wanting this exposure, wanting it in their retirement / compensation plan. And also those are the people who can bring the Bitcoin development company idea to life.
Yeah,
You
absolutely.
know? And then speaking of that, what we're gonna do here today is we're gonna close on this slide and a little conversation about this. You've already heard me talk about the monopoly concept a few times here and in, you know, several or like many of my posts, because like I said, this is just something that I'm very interested in. It's hard not to look at this chart and not think that like without any other information that like one of these is a monopoly for this specific use case of being like the premier operating company that has a ton of Bitcoin exposure. And just to hit the high level of the numbers here, MSTR, of course, has 214,000. That's this figure. But then when we look at everyone else combined, right, the sum of number 2 to 38, and I only stopped it stop there because the data store stops there. I'm sorry, the data source stops there on the first page, and this kind of might be it, because if the last company only has 3, I mean, plebs have more than this company. So perhaps this is kind of like where the list ends for the global public company totaler list of Bitcoin. So then the next calculation, of course, is to see MSTR's multiple versus everyone else combined, and it's truly remarkable to have 2.25 times more Bitcoin than everyone else combined. And one of the key things that I kind of want to talk about with this slide is that it's more than just what's, you know, in the moment now. And one of the other calculations I can show here in the margin is if we just look at MSTR versus Mara, MicroStrategy has 12.3x more Bitcoin than the number 2. But like I said, I want this to be more than just the here and now for conceptualizing, like, at least why I think this is such a big deal. I don't think there's really any other company that's going to be able to catch MSTR in this regard. And there's a list of reasons for that. The first one being, and this goes back to our friend Dylan LeClaire, who's also, you know, talking about MSTR in videos himself, talking about this being the most compelling opportunity in corporate finance or something along those lines. But the one idea that I want to focus on from Dylan is that he kind of keeps coming back to this idea of like, oh, all the other, you know, CEOs have been like put on notice now for noticing like the strength of MSTR stock over the past 15 or so months since the FTX lows. And now they're going to have to like all react to this kind of like all at the same time. For me, I really can't imagine that happening, right? This is kind of the same reason that I got laughed out of the room when I brought this up to Bristol Myers Squibb about like, you know, should we really take seriously, or I was saying we should take seriously the idea of adding Bitcoin to the balance sheet, because I think it's one of the best things that we can do for not just shareholders, but for the patients, right? Because in order to have like an operational company, we're going to have to stay solvent and not participate in kind of like the fiat decay of things where, you know, perhaps value stocks become much less attractive to investors, and we kind of keep fighting this kind of opposite of MicroStrategy. We have like a negative reflexive flywheel that we're dealing with both in low interest rates and high interest rates. So I feel like there was a compelling case to be made there. But one of the main reasons that it made sense that I got laughed out of the room was because mechanistically, most companies just can't do this, right? The board plus the CEO minus one group, which is everyone who's a direct report to the CEO, like the CFO, the CIO, chief tech officer, that whole group plus the board plus the CEO. In most companies, that group doesn't even like own a considerable portion of the stock or the voting rights for the stock. this is where it comes back to MicroStrategy in that, yeah, Saylor's the biggest, shareholder, mainly with his Alcantara LLC. He owns about 2.4 million shares in total. But the real magic is that he has 60 something percent of the voting shares, meaning he's able to take such aggressive action as it pertains to Bitcoin without having to have this massive committee process and never kind of reach a status quo narrative between the group. When you have one person who's the biggest bull out there and he can just act on this immediately, that to me kind of creates a scenario where I would think the the only other conceivable company that I could see taking a material position in MSTR is Meta.
Or Bitcoin in Bitcoin.
I'm sorry, yeah, a material position in Bitcoin is Meta because Zuckerberg has, a controlling voting interest in the company. Plus, he owns Bitcoin personally, and he has that that mechanistic option of like actually being able to take action on this. The reason I don't think he's going to do that, right? Because I'm just saying he could. The reason I don't think he's going to do that is because in their most recent earnings call, he announced the beginning of a dividend, which is very, very interesting because typically once a company starts paying a dividend, they never stop. It's not like a buyback where they easily turn those things on and off. So he announced the dividend, the start of one, and he announced another something tens of billions, maybe 50 billion in buybacks. So if he's allocating that much, return of capital to shareholders in the form of buybacks and dividends, then it kind of would suggest that he's not interested in putting Bitcoin on the balance sheet, and he's really only interested in putting that on his personal account, which is kind of nice because then it gives the investor the opportunity to hold Meta stock and some type of Bitcoin exposure. But let me go ahead and pass it to you here.
Yeah, I mean, I agree wholeheartedly. It's I don't think there are many that can catch MicroStrategy. I think there's been a couple of people that have commented that even if any other operating company were to buy a significant holding, that they would instantly surpass MicroStrategy. And I think there are some caveats to throw onto that, right? Like let's just say Meta buys 50,000 Bitcoin. In order to do anything with that Bitcoin and become a Bitcoin development company, they would have to completely divert assets that they currently have to do Bitcoin development. And I think that they could be successful in that strategy, but there could also be competitors and different sizes and scales of corporations that own that many Bitcoin. So I don't know. The next 12 months are going to be really interesting. I don't think I don't think owning 214,000 is a bad thing. And being the number one holder is pretty impressive.
And I think there's something of an escape velocity element at play here, right? And Jeff, you and I have talked about this in the past where even though it may be unfortunate as price goes up, that an investor has to come to terms with the fact that, okay, MicroStrategy won't be able to, acquire as much Bitcoin because of the price going up. It's just there's a finite amount of fiat dollars, even with both the debt and leverage and the convertible bond market. Plus, I I have heard Saylor on one podcast definitively say that he would buy Bitcoin up to $250,000. So he has kind of hinted directly at like what his like max capacity would be. So while it may seem like bitter that as price goes up, you can kind of start to compress or decrease the total amount that MicroStrategy can end up having. However, I would say there's also like a very real sweet element to that bittersweet combo in that as price keeps going up, it closes the door tighter and tighter and tighter on every other company on earth, right? During a time where you got like these brand new ETFs that are like, providing this relentless bid. So in both ways, whether price goes up or price kind of stays here, or even if price goes down, um, there's really like a solid method for MSTR to exploit that. And even though like a lot of us think like the price is going to keep going up, if it does, the great thing there is that it just closes the door on everyone else, which I already think that the door is closed, if I'm being quite honest. However, I'm just typically very conservative. I almost never throw price targets out there, and I'm just typically very conservative with these types of like future facing statements. Um, so yeah, it's bittersweet, you know.
I think the graph that you got on the right is great. I like the bar chart. It's it's a lot. It's a lot.
Yeah, this definitely doesn't fit the normal standard distribution bell curve. You know
No.
what I mean? Or you could say it does, but it would just have such a fat tail on either the left or the right for MicroStrategy, because the average in the middle, like the average in the middle is probably like somewhere here.
Yeah.
And like MSTR has, 200 times more than that, like average in the middle. So to be this
Oh, the
huge,
median. You're talking the median. Yeah, the average is probably what 7,000 or something, but the median is oh, there you go. Just do it on the fly.
okay, so we got the numbers here. When we look at the average Bitcoin holding, when looking at all the companies, including MicroStrategy, we get this, 8,100 figure. When we look at the median, it's only 700. And again, that's counting MSTR. And what that kind of shows from a statistical perspective in terms of the skew, the average is pulled 10 times higher than where the median value is, all because there's this one massive like outlier data point involved here, which is MSTR. It's almost like if you look at the average net worth in Omaha, Nebraska, and you've got Warren Buffett, and then you've got everyone else, it's gonna look like a chart like this, where one metric just dominates it all to one side, and the average ends up being 10 times higher than the middle point. That is
Yeah,
cool.
it's that's a cool data point. And I think the interesting the part that makes me excited about this is thinking about the Q1 earnings, because people have said, oh, Mara's already done FASB for their last quarterly earnings, and the price didn't change much, even though the earnings per share was higher than it was than the prior. Now, and they were saying like that's going to be the same situation that happens with MicroStrategy, but it's not, right? Because they've got 12 times more Bitcoin than Mara does, and I think the number of holders and the number of shares that are trading at the margin for MicroStrategy is significantly less than Mara or any of the mining companies. So it should be interesting. I think the next month, the next 12 months is going to be a lot of fun.
Yeah, no, for sure. Of course, we'll be very like interested and excited to see how this kind of stuff ends up playing out for MicroStrategy with the post FASB fair value accounting. And it'll also be interesting, of course, to compare that to what ends up being the impact with Mara, what ends up being the impact with Coinbase. Because both those two in particular, both mining and exchanges, they're very like heavily competitive industries with other
Yeah.
like quality companies, and there's not too much distinction. I know the mining mafia will crucify me for saying that, but MSTR is more of a true one of one type entity, whereas there's five good miners, five good exchanges. Pick
Yeah, I think
pick your
Stephen I think
yeah.
Stephen
It,
Chow called them collectibles. MicroStrategy shares are collectibles. I'm like, yeah, man, they're like rare Michael Jordan rookie cards from the 1980s. Like it's
Yeah, no, I saw the Jordan comment, and I think that's so spot on, and perhaps a really good place to end this conversation, where You know, you
Yeah.
look at a Jordan, that's a true like one of one type entity, and everyone else was really just competing for second place. And that, and not to oversimplify this whole thing, but I could say that, you know, MSTR is the Michael Jordan of the Bitcoin equities, and everyone else is just going to be trying to compete for second place. You know what I mean?
I like it. I think that should be the title of this episode. Is
Wow.
MSTR the Michael Jordan of Bitcoin equities? Or MSTR is the Michael Jordan of Bitcoin equities. There it is. Boom. All right, I gotta go to bed. Thanks for having us, everybody. Thanks for listening. Thanks for tuning in. We'll have more Quant Bros episodes in the future. This has been a lot of fun. If you guys we love the feedback. Any feedback is great feedback, and I look
Sure.
forward to chatting with Ryan more. Cool.
All right, friends. Thanks for joining us, and we will see you on the Twitter sphere. You know what I mean?
Absolutely.